Welcome to The Prescription, the Tax Policy Center's bi-weekly webcast on fiscal policy for the COVID-19 economy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists, lawyers, and other experts. Our guest today is Professor Daniel Hemel of the University of Chicago Law School. Before joining the faculty there, he was a law clerk to Associate Justice Elena Kagan on the US Supreme Court. Professor Hemel's research focuses on taxation, nonprofit organizations, administrative law, and federal courts. Thank you, Daniel, for joining us.
Thanks for having me here.
Yes, before we begin, a bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. Please identify yourself and your organization as if you are asking your questions in person. We will try to get to your questions as we have time, but I caution you, we have a short segment, so we may not get to all of them. We have closed captions turned on. If you'd like to adjust your settings, click the live transcription buttons at the bottom. This event is being recorded and will be posted online at TPC's website in the near future. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrbanToday. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. We always welcome suggestions. Okay, again, Daniel, thanks. Today we plan to discuss first the state and local tax or SALT deductions, and second, other reforms for taxing the rich. Daniel has written about both of these topics recently, and you can find links to his articles in the chat. So let's start with the state and local tax deduction, which has been in the news a lot after the 2017 tax overhaul that capped those SALT deductions at $10,000 in general. Professor Hemel, Daniel, how long have the SALT deductions been around and why are they there?
The SALT deduction has been around since, in some form, since 1861. The Revenue Act of 1861, the first congressional attempt at an income tax, included a deduction for state and local property taxes. At the time, Congress had a kind of funny reason about intergovernmental tax immunity for allowing the deduction. But over time, we have evolved a number of other reasons that we'll talk about today for keeping the deduction around.
Are they good tax policy SALT deductions?
The way I think about this is I think about salt the same way I think about pepper. Is pepper good? Well, I'd kind of like to know what else is on my plate. Pepper is pretty good with scrambled eggs. It's going to be less good with ice cream. If we have a super progressive tax code, would I want a SALT deduction as part of that? I think I would, for two reasons. First, I think we get a better measure of ability to pay if we subtract out state and local taxes. I think someone who's making $1 million in New York and paying $100,000 to the state, we should think of that person like having the same ability to pay more or less as someone in Texas or New Hampshire who's making $900,000. And two, the SALT deduction incentivizes states and localities to raise revenue from the rich. You could think about the SALT deduction as basically the federal government saying to states, for every 63 cents that you raise from a top bracket taxpayer, we'll kick in another 37 cents. Right? If we have a code that is insufficiently progressive, one way to make it more progressive is to get rid of the SALT deduction or to cap the SALT deduction. So it's really what else is on the plate.
Well, in your recent article on the SALT deduction, I think your bottom line, you said that you viewed the SALT deduction sort of ultimately as a subsidy for civic institutions that strengthen democratic fabric. What did you mean by that?
I mean, the SALT deduction, we can think about it a lot like the charitable contribution deduction. If you think that we should incentivize giving to charity, then for similar reasons, we should incentivize giving to states. For the most part, what states do is they provide health, education, and public benefits, and almost everything else is a rounding error. Roads, but roads are classic public goods. One difference between giving money to a state and giving money to a charity is that when you give money to a charity, you have a lot more control about where exactly it goes. Whereas when you give money to a state, you're leaving it to a democratic community to decide how the money is allocated. So I think actually the latter is better. So insofar as we're choosing between the two, the case for the state and local deduction on the whole seems stronger to me than the case for the charitable contribution deduction, with a few caveats.
So why did Congress limit the state and local tax deduction in the 2017 bill, cap that at $10,000 and not cap the charitable contribution and other personal deductions? It seems as if they got that backwards, maybe.
I think there were a bunch of things backwards about the deduction changes in the 2017 tax law. I mean, I work for a public charity. I work for the University of Chicago. You work for a public charity too. We're pretty effective lobbyists for our own interests. So that might be the answer for why the charitable contribution deduction wasn't capped. And I think I would rather it be a refundable flat rate credit than a deduction. But on the whole, it's subsidizing positive externalities. I think we got it wrong in another way, in that both the SALT deduction and the mortgage interest deduction subsidize home ownership. I don't think the federal government should be subsidizing home ownership, but the SALT deduction accomplishes other things, whereas the mortgage interest deduction, which survived, really is just a pure home ownership and debt subsidy. And if we are going to limit the SALT deduction, and I think some limit might make sense, it would probably make more sense to put a floor under it rather than a cap over it. Victor Thoroni has proposed the idea of just having a 5% of AGI limit, a floor, and only SALT payments over that would be deductible. That actually makes a lot of sense to me, because at the margin, it would incentivize state and local revenue raising from the rich.
Well, the other thing the 2017 tax overhaul did was to double that standard deduction. And as you know, taxpayers can elect either a standard deduction or to itemize, say, non-business deductions. And that doubling of the standard deduction, I think, shoves more people into the standard deduction framework and fewer people trying to deduct any state and local taxes at all. You know, was that sensible? And what do you think of the standard deduction as an alternative to itemized deductions? Isn't that, in effect, a limitation on SALT deductions also? How long has that been around?
The standard deduction has been around since the 1940s, and it plays two roles. One, it's a zero bracket, and I think it makes a lot of sense to have a zero bracket. It allows some low-income people not to file at all, and it makes the code more progressive. It also limits itemized deductions, and it really depends whether that's good or bad based on the itemized deduction. Limiting the mortgage interest deduction strikes me as a good thing. Limiting the charitable contribution deduction is a less good thing. If I were writing the code from scratch, we'd probably just have a more generous zero bracket and allow everyone to claim a tax benefit for charitable contributions, and probably some sort of tax benefit for state and local tax payments too.
Well, who won and who lost in this latest cap on state and local tax deductions? Which taxpayers, which states?
Well, it didn't happen in a vacuum, right? It happened as part of a huge tax cut, and a tax cut that primarily went to the rich. So even most top 1%ers in New York benefited on net from the Tax Cuts and Jobs Act changes. If you look at the $10,000 cap in isolation, while the big losers were higher income taxpayers in primarily blue northeastern states, plus Maryland, DC, California, Oregon. But they lost, but they only lost temporarily. So right now, time is on their side. It comes back in 2026 if Congress doesn't do anything.
How about New Jersey? New Jersey's been very loud in complaining that they were targeted by the SALT cap, and New Jersey has been claiming, contending that they are New Jersey's givers, not takers. They get like only 67 cents back on the amount of money they send to the US government, and they think they lost big when their residents lost the ability to have the federal government share in some of the New Jersey tax expenses.
New Jersey is a high income state. So if we have a progressive tax system, New Jersey should be a net giver. And I think that's a good thing. I think we should be doing more redistribution from New Jersey and Maryland to Mississippi and West Virginia than we do. I think the New Jersey argument does to some degree take the edge off the critique of the SALT deduction that this is just subsidizing high tax states. Well, high tax states, which are largely high income states, are really subsidizing the rest of the country, and that's as it should be. New Jersey has also made a constitutional argument here that the SALT cap is unconstitutional, and that strikes me as borderline frivolous, but definitely not a winner.
Well, what do you think about those states that are trying to work around the limits? My colleague Kim Rubin posted a blog last month that was a roadmap for states and the law firms especially to start paying taxes at the partnership level and sidestep these limitations at the individual level. What do you think of self-help?
Right, so there are three versions of self-help. There was the first was the state charitable credit programs that Treasury effectively shut down. And I'll admit I was active in promoting those state charitable credit programs, in part because what had been happening pre-2017 was that there were states like Arizona that basically allowed you to redirect state taxes from the state to private and parochial schools and have that count as a charitable contribution rather than a state and local tax payment, which allowed you to get out of AMT limitations on the state and local tax deduction. And that struck me as bad. But if you were going to do that for private and parochial schools, why not do that for public schools too? And basically what New York and California ended up saying to the federal government is, you've got a choice. You can shut the Arizona program down, or we're going to exploit that loophole too. And Treasury made the choice to shut it down and shut it down for everyone. And I think that was on net an improvement. The second workaround, which a lot of states are now doing, is to shift taxes to the partnership level or to the entity level and allow. Treasury says that you can deduct those as ordinary necessary business expenses, not subject to the cap. The $10,000 cap. I don't think that works under Section 164. I think that Treasury has taken the wrong interpretation of 164 here, and I think pretty clearly wrong interpretation here. And it just exacerbates an existing preference in the tax code for pass-through entities over those of us who happen to get our wages on a W-2. The third workaround, which New York has actually implemented, and several hundred employers in New York are using it, is to have the employer pay a payroll tax and then have employees relieved of a portion of their state tax liabilities. That I think really does work under 164, but it involves people taking a cut in their nominal pay, which people don't love to do. Several hundred sophisticated employers in New York are doing it, but the rest of the country hasn't really caught on.
So the workarounds will end with the SALT limitations in 2025, but then in 2026, we need to decide what to do. What is your favorite? Should we restore the SALT deductions and just like raise tax rates on the highest income taxpayers? Should we convert the SALT deduction into some form of a grant program? Should we just like eliminate itemized deductions completely? What's your favorite path before we shift to the next topic?
I mean, my favorite path would be, we'd have something like a 70% tax rate at the top, and you'd probably want a SALT deduction there because we'd want the revenue maximizing tax rate, but the revenue maximizing tax rate isn't going to be the same in California and Texas if you don't factor in the existence of California state income taxes. Would it be a complete SALT deduction? No, there would probably be something like a 5% of AGI floor. Maybe we disallow a deduction for property taxes, which effectively acts as a home ownership incentive as much as it is a state revenue raising incentive. And we do something with transfers to help out lower income states and to make federal support for state and local governments less cyclical. So effectively, the subsidy that comes with the SALT deduction, and this is a point that Len Berman and Tracy Gordon and others have made, the subsidy increases when people are paying more in taxes, so in boom times, and decreases in recessionary times. And that's the exact opposite of what we want to do. So we change a whole bunch of things. Hopefully, we won't just go back to the pre-2018 status quo.
Well, let's shift to other good ways to soak the rich. Why are we trying to tax the rich and high income more heavily? What's the goal? What's the objective here?
So two reasons. One, I'm a welfarist, basically a utilitarian, and I think at the top of the distribution, the marginal utility of income is really low. So when Jeff Bezos pays $1 to the federal government, I think of that as like a pure $1 gain to society. So we should basically tax Jeff Bezos until we're at the peak of the Laffer curve. And I'm not sure where that is, but I think it's somewhere in the 60 to 80 range. So that's my welfarist argument for taxing the rich. There's also the question of whether we should tax capital as opposed to the labor income of the rich. And this is a different question than whether we should tax capital gains, because a lot of capital gains are really disguised labor income. I think the consensus in optimal tax theory until relatively recently was that if you have the optimal labor income tax, you don't need an additional capital tax. I think that's changed with sort of the new dynamic public finance literature, work by Ludwig Straub and Yvonne Werning, who I think have made a pretty persuasive case that we do want to tax capital, and capital is mostly owned by the rich.
How would you rate President Biden's proposals to step up tax on capital, the ending of the step up basis at death, the taxing capital gains at the same rates as ordinary income, trying to get more realization events by eliminating the like-kind exchanges? How do those stack up?
Pretty well. I'd say it's like slightly more than 50% of a loaf, right? So better than half a loaf, but not the full loaf. Stepped up basis is the biggest loophole in our capital tax regime. So dealing with that would be a definite improvement. You'd still have a substantial deferral advantage over the course of your lifetime, but we'd be collecting something from some income tax from Jeff Bezos on his $200 billion of lifetime gains. That strikes me as a good thing. And the optimal rate goes up if you have fewer holes in the base. So I think moving from 23.8% to 43.4% would make a lot of sense. I would go higher than 43.4%, but like definitely a movement in the right direction. There are loopholes. The biggest loophole, I think, is life insurance. So life insurance would be completely outside of the Biden stepped-up basis regime. Getting rid of like-kind exchanges, clear improvement. No real argument for giving this big tax benefit to real estate developers who already have or real estate owners who already have lots of tax benefits. It's not totally comprehensive. So Section 1202, the qualified small business stock exclusion, that should go too. But we'd be like a lot closer to the ideal world under the Biden.
What about some of the other ideas? You wrote a fascinating article that described wealth taxes and mark-to-market taxes and something known as a retrospective tax. You demonstrated that they were equivalent. We don't have time to work through your algebra here. However, what are these other taxes, just at a high level, and do you think they could work?
So we'll go in order. A wealth tax, yeah, it could work. Would there be, it could work setting aside the constitutional issues. Would there be valuation issues? Sure, but I'm not exactly sure what Jeff Bezos's net worth is, but I could come pretty close to a right answer there. So it would raise revenue, and it would raise revenue now, which is a benefit over something like getting rid of stepped up basis, or really getting rid of tax-free stepped up basis at death, where a lot of the revenue is going to be way down the road, and Republicans might take charge and repeal it before Jeff Bezos ends up paying anything. That said, I'm not sure if there are 5 votes. I think there aren't 5 votes on the Supreme Court to uphold a wealth tax. So unless President Biden is going to pack the court, then I don't see a clear path forward for a wealth tax now. Mark to market, I think, could also work and would generate revenue now. And for publicly traded assets would be pretty easy to administer. And for non-publicly traded assets, we could do something like wait until realization and then impose a deferral charge. There are a few constitutional issues with mark-to-market taxation, but I don't consider them super serious, whereas I consider the constitutional arguments against the wealth tax to be weighty. And then a retrospective capital gains tax would just be basically waiting until realization for everything, including publicly traded stock, but charging taxpayers for the benefit of deferral. And there are a few different ways that you could do that. But for the most part, if we assume normal rate of return, they all end up more or less at the same place at the end, except that in our current political environment, a wealth tax might end up with 0 at the end. And with a retrospective capital gains tax, we do have to worry about it being repealed before we get to the end of the road.
So you view the wealth tax as potentially suspect constitutionally, although perhaps easily understood. The retrospective tax at the other end is pretty robust on the law, but I suspect actually will confuse US taxpayers who are so experienced and reliant on the realization doctrine that you only pay tax when you sell something, that it may yet raise some additional concerns, maybe political.
Yeah, and I should be clear, if it were just me and I were voting on a wealth tax, I think I would vote to uphold, but that and 2 cents will get you, I don't know, what can you buy for 2 cents these days? I think if we're talking about how to seriously tax the rich, we should think about John Roberts and Brett Kavanaugh's views, unless we're going to do something dramatic to the Supreme Court. With retrospective capital gains taxation, I should make clear, you would be waiting until realization. So I don't think this would be, I think people would accept the idea of a deferral charge once you could explain it to them, and there'd be a little bit of a challenge on explanation. It would be really easy to administer. The big problem with the retrospective capital gains tax is we could say we're going to do it, we could enact it, but then President DeSantis might repeal it in 2029.
So a lot of political uncertainty. But what do you think about our current estate tax, which hasn't been very effective at raising money? Could we replace that with an inheritance tax? Would that be more effective?
I mean, I think we could fix estate tax loopholes pretty easily, at least some of them. And Treasury probably has the regulatory authority to do some of that already. And I'm not quite sure why it hasn't yet. But zeroed out grantor retained annuity trusts, I think there's probably a lot of regulatory room there. Family limited partnership valuation issues, the Obama administration came close to addressing that and really ran out of time. And we need, with a $22 million exemption for couples, or I guess close to $23 million now, it's pretty easy to get out of the estate tax unless you're super, super, super rich. So those exemption levels need to come down, but they'll come down in 2026, even if we just go on autopilot from here. On an inheritance tax, I think people like the idea of an inheritance tax more than an estate tax when they hear it. On the other hand, to make an inheritance tax equivalent to an estate tax, you need to bring the exemption level down because most people have more than one heir. So I'm not sure whether a $4 million exemption level with an estate tax ends up being more popular than an inheritance tax, where to make it equivalent, we have exemptions of $1 or $2 million.
One of our audience members asks about financial transactions taxes. There are a whole bunch of transactions. Suppose we nick them for a small fee each time. I guess the ultimate burden would fall on those who own those assets, which tend to be overwhelmingly the rich.
Yeah, I mean, I would think of, we should think about whether liquidity is, whether we want more liquidity or whether we think that flash trading is for the most part a public bad. My view leans toward the latter. So if some of the brightest minds of our generation spent less time programming computers in basements in New Jersey to be trading stocks really fast, that would probably be good for the world. But I think the strongest argument for a financial transactions tax is that it would make our market stronger rather than that it would soak the rich.
So we got a couple of we got lots of great questions in the box. I don't think we have much time left, but here's at least one. What evidence is there that state fiscal policy responds to the SALT deduction? That is, if there's a complaint that states will provide fewer services to low-income taxpayers because of the loss of the deduction to their residents, that seems like a problem. But if that premise was untrue, then it's not a problem. What evidence do we have on that?
I think we do have evidence. Douglas Holt-Seakin has a paper from the early 90s. Howard Chernak has some more recent work. So does Brian Galley that suggests that there's an effect. It's really hard to do a controlled experiment. But we also just have evidence that taxpayers respond. So there are a lot of high net worth people in California who set up Nevada incomplete gift non-grantor trusts. And if you want to know the details of that, start Googling around for NINGs. And it's like interesting. It works as a state tax avoidance move. There's absolutely no reason why you would do it except for state tax avoidance. So we have evidence out in the world that high-income people are avoiding state income tax, and that means that there's less revenue for the states. I don't feel all that bad for California because it's gotten a huge revenue haul over the course of the last year, but there's definitely avoidance out there. I mean, there are a lot of New Yorkers who are spending 183 days in Florida and counting.
Another question we have is someone who's concerned that the marginal tax rates, when you combine federal and state taxes, can exceed 100%. Wouldn't that be a pretty compelling reason to allow a deduction for state taxes?
Yeah, we're nowhere close to there yet. I think New York City residents are getting at the very high end, are now above 55. But that if we had a 90% tax, state income, federal income tax, as we did under President Kennedy, and you had a 13.3% California income tax, then right, you would need a state tax deduction.
Okay, any last words? I think we're about out of time. Any last comments you'd like to share on how we're going about taxing high income and the rich?
There are lots of different ways to tax high income people, including raising rates. And by high income, I think I would include, the top 5% rather than the top 1%. So people with six-figure salaries, whether or not they're above $400,000. But look, the Biden proposal, if we end up getting half of what the Green Book proposal proposes, it would be the most progressive tax policy change in 2 generations.
Okay, well, Professor Hemel, Daniel, you've been fantastic. We've tried to compress a lot of information into a very short slot, and we've had a pretty big audience for a summer talk about tax. So thank you to all who have attended.
Thank you.